not a big fan of AI.
Good morning, everyone. Thanks for being here. And thanks for those who are online and joining us through live streaming. I'm Carlos Teixeira, and I'm a faculty member here at the Institute of Design, also the director of the PhD program. I'm also today in the capacity of being the primary advisor for Jordan. So multiple hats, and I'm very excited to be here and for this very important event. So today what we're gonna have is the oral defense of Jordan Ostapchuk, and we are gonna have our committee later going through the evaluation of his work and defining the path and trail of his dissertation. This is a committee that I'm the primary advisor. We have also Wesley Ashton as part of the committee. I need you, Matthew, as well as Ben Van Vliet. Thank you all for being in this journey with Jordan. Just to situate why we're here and what we're gonna be doing, in the whole process of a PhD, we come to the end and we have the public oral defense. It seems just one more talk, but it's not. The public oral defense is the last event that we have on the PhD. And it's public and it's an oral defense because the tradition is about you sharing the knowledge that you developed, that you created, that you produce with the public. So this is the time where your knowledge is supposed to be an original contribution to the common good, and you make that presentation and offer that knowledge to society. Your dissertation is also a public document where everybody should be able to access. So this is the moment where we get out of our rooms and internal conversations, and we turn outside to the public and share that knowledge and do our contribution, our original contribution to our field, but also a contribution that can be leveraged by society. So that's what Jordan's going to be doing today, presenting his work on capital design. Our agenda is going to be about 40 minutes for Jordan to do his presentation. Take all the time, enjoy the ride, and at the end, we're going to have 10 to 15 minutes of question and answers. We're going to be question and answers only from the room, and this is more for the audience to make questions, and instead of our committee. Our committee will go afterward and meet with Jordan. So that's for today. Please welcome Jordan for his presentation.
Thank you, Carlos. I heard pass, fail, and contribution to society, so we'll see. We'll see how that goes. Good morning, everyone in the room and online. My name is Jordan Ostapchuk, and I'm a capital designer. And I've introduced myself as such a few times before, but I think only now, after 3 years, I fully understand what that means. So over the next 30 to 40 minutes, as Carlos mentioned, I'll share the research journey that leads me to justify my optimism for design's ability to influence the next $100 trillion of institutional investment in our economies, ecologies, and societies. But first, some context for those of you in the room and online. My name is Jordan, and I'm in my third year and hopefully final year of the PhD program. So we're here in Chicago at the Institute of Design, and I started as the first ever corporate partnership, which means I was working full-time while doing the PhD research, and my work environment was also the research context, which is very important, and I'll share a little bit more on this later. So a PhD journey, as you all know, is never done alone, and my advisory committee has been absolutely phenomenal, led by Carlos, with Ben, Weston, and Anijo. Really appreciate the constant support, challenge, and collective contribution to this. And to the broader PhD community, Dia and I we were the first two, and everyone else in this room, really appreciate your thought partnership and coming with me along the way. and I would be remiss to not mention my wife Laura and my two sons, Jake and Luke, are very, very excited to get their husband and dad back after this. So what you are about to hear is the result of 3 years of personal and professional work. It started simply by solving my own problem. Even before I was in the PhD, I had this challenge in my professional life, and I said, I need to reach out to a community of people who have a different set of solutions to this new type of challenge. So building from a hunch, to a vastly overcomplicated view of the world and back down into a simple yet powerful idea, which is much like the design process. It was not linear, it was very iterative. So over the next 40 minutes, here's what we'll do. Introduce the capital paradox and the context of institutional investment. We'll trace the transformative influences of capital and define our terms. We'll introduce design to the investment context and explore why it's not yet there, or at least to the extent that it fully could be. We'll explore design's role in institutional capital allocation. We'll identify the factors that influence design in the investment context, share 8 design capabilities that collectively form capital design, which can influence capital allocation. And then we'll move from the capital paradox to the capital paradigm. Start to think about some of the implications on not just design, but the institutions around us. And lastly, we'll see how design can actually then influence through capital allocation and look at what's next. So by the end, I hope you'll come away with 2 things. First is fully appreciating the invisible power of institutional capital that shapes the economy, the environment, and society in many visible and invisible ways. And second is seeing design in a new light, which is capable of influencing this massive and transformational force of institutional capital. I hope to convey the relevance, rigor, and gravity of this research while sharing a bit of the human factor of the journey along the way. So as Carlos mentioned, I'll save time for questions from the public right after this, and then we can go into the other room for the additional grilling and hopefully see you all at lunch. So I'll start with the capital paradox. Just come right out and say it. At the heart of the $100 trillion institutional investment industry, there's a paradox. The greater the variety of investment choices an institution has, the more challenging it becomes to make investment decisions. So although this paradox is largely unrecognized, I know it was invisible to me, it has a massive impact that's evident across the societies, economies, and ecologies. So I'll break it down. So on one hand, major institutions, which include pension funds, sovereign wealth funds, endowments, mutual funds, exchange-traded funds, insurers, collectively manage trillions of dollars as fiduciaries. And being a fiduciary means you act in the best interest of those you're invested for. And these are largely not investing for profit. They're investing to pay pensions, to pay scholarships, to pay endowments, to pay life insurance policies. So this capital must be invested to meet these long-term liabilities, often dating decades, if not even centuries. And on the other hand, you have this global imperative for transformative investments, this massive, massive need for capital. Think about energy transition, climate change, just building basic infrastructure. There's this huge need for capital to address society's most pressing needs. But what we have is this growing disconnect between the variety of investment opportunities and institutions' ability to effectively allocate capital to these opportunities, right? So despite the availability of all this money that needs to go somewhere, and the amount of opportunities that desperately need capital to serve society's needs, there's a disconnect. What's happening? So the direction of capital flows significantly influence the approach to addressing climate change, aging populations, and the transition to sustainable energy, in addition to supporting the essential physical and social infrastructure supported by institutional capital, right? Because it's not just the physical world that we have. Most of these institutions support the social infrastructure in some way, largely by allowing people safe and secure retirements as they go forward, sovereign wealth funds, scholarships, and the like. I mean, in short, if I was to summarize this slide, this matters. So I think hopefully Ben will be happy with this slide. Ben's always been big on definitions, which I think is so important. And I'll start with the first observation, and then I'll get into 2 definitions. The central observation of this, and this may seem obvious to some people and may seem not obvious to others, and it's always surprising who finds it obvious and who's not, is that capital is one of the most transformative elements of the 21st century. But also, design is in the business of transformation, yet curiously, it's not proficient with engaging in capital for reasons which we'll see. But to quote Voltaire, and maybe to quote Ben, if we wish to converse, we must first define our terms. So there's two definitions of capital that we're working with in this dissertation. The first is concrete and the second is abstract. So the first is more of the technical, but I think very, very important definition of capital, which really bounds it in the institutional investment context, which helps because we're talking about how investment decisions are made and how capital flows. So capital is the combined total of contributions and investment returns pooled into a fund, available to be deployed into a set of investment opportunities within asset classes to meet a specified goal. Right? This goal is often expressed as a risk-adjusted return relative to a risk-free interest rate, but may also account for other market constraints such as liquidity, volatility, yield, or outcomes tied to social, sustainability, or special interests. The purpose of capital allocation here is to perpetually generate more capital. That's a really important definition of this institutional piece. The purpose of capital allocation is to generate more capital, which is either reinvested or distributed to contributors through pensions, insurance policies, scholarships, or other forms of disbursement. So here, capital is inherently neutral to where it's deployed, so long as it can generate that return. So that's the very concrete definition. The second, more accessible and more abstract definition is simply to think of capital like air. Right? It's invisible to the naked eye, but it's discernible through its effects on other entities. Its movement from one place to another can reshape the world for better or for worse, much like wind can generate electricity or destroy homes. Similarly, capital can drive economic and societal progress, or it can finance human conflict. Right? The movement of capital is a powerful force that shapes our economy, societies, and physical environment, both directly and indirectly, visibly and invisibly. So with those definitions in place, why has capital been so transformational over the last decade? Right, so there's three reasons that we can boil it down to. The first is financialization, the second is universal ownership, the third is systemic risk. They're all connected into a big systems loop, and I'll quickly break down each of them so we can set the stage and then get into the design component of all of this. So financialization is the ability to turn almost anything into an investment opportunity by looking at it essentially as a series of cash flows. So everything from cemeteries, laundromats, student loans, carbon credits, you name it, a banker can turn it into an investable asset. The second is universal ownership. And this is really the concentrated ownership of huge swaths of businesses, whether that's infrastructure, resources, businesses themselves, right? And these universal owners effectively cannot diversify away from risks anymore. They cannot beat the market because they are the market. So there's effectively a handful, let's call it 20 large in the hundreds of billions, if not trillions of dollar plans that cross-own ports, bridges, power plants, businesses, even entire stock markets, just by the sheer complexity and size and the compounding effects of capital, right? So these universal owners are thus invested in the health of the economy as a whole, and they're the main actors of this research, right? So the pension funds, insurance companies, and the like, they don't think of it as such, but they are all reliant on economic health, GDP, and are on the hook if anything goes wrong with that, right? And then this takes us into systemic risk, where it emerges from the confluence of these two factors. Systemic risk is what happens when several seemingly uncorrelated events happen at the same time to create economic impact. COVID was a phenomenal example of this. The resulting impact on unemployment, supply chains, inflation, altogether. So then capital, if you looked at the diagram on your left there, is really caught in this self-reinforcing loop where we are today. As the web gets more complex, it all becomes more difficult to make investment decisions amidst this risky environment, all while the amount of capital is still increasing from the outside that needs to go somewhere, right? So think of it as financialization exposes more aspects of a society to the possibility for investment, and universal concentration concentrates that ownership. Anything that impacts the global economy also impacts universal owners, right? So therefore, capital allocation at its current scale exposes all of the participants, all of the investors to every conceivable risk, fostering financial independencies and the systemic risks that they actually tried to diversify away from in the first place, right? So these owners are invested in the health of the economy as a whole. So we need a novel approach to capital allocation that acknowledges the linkages between these non-economic crises, often called polycrises, and the economic systemic risk that underpins them. So the point of this, in this chapter in the dissertation is really by foregrounding these socio-financial systems, we can then situate design and say, okay, where can we start? We can start to map the territory of capital and the different ways it is interrelated. So introducing design into the investment context, right? Where is design in all this? Why is this dissertation even being done at the Institute of Design and not at the Stewart Business School? Like, why? Why is that? The short answer is to where is design? Well, it's both everywhere and nowhere at the same time. So first off, design really has its fingerprints all over the current situation. And I'll quote, given that much professional design since the 1970s has been unequivocally neoliberal, and additionally that processes of neoliberalization are indebted to design, some might argue, and there's a large contingent that do, argue that design has a duty, because it's been implicated, to impact or at least kind of fix some of the earlier challenge of investment. Designers have been implicated in the development of these extractive business models like Uber, Amazon, Facebook, which propelled much of the last decade in stock market gains, and only realizing now that segments of design have been fully co-opted by technology, and that human-centered design sprints really do have their limitations in the scale of transformation they can make. However, on the other side, for all design's presence in that business layer, in the productions of, or so the context of use and context of production, we find from the empirical evidence that design lacks a forceful, active, and deliberate presence in the capital allocation level, which sits one layer above. So you see this image over here. The bottom two is actually from Carlos's dissertation, talking about context of production, context of use, and the different areas design plays a role and creates value, building earlier on John Heskett's work. But in the context of investment, where is design, right? And we'll come back to this model a little bit later, but just to point out that it's not there. And it very much helped frame and guide the research. So on one hand, design is everywhere as a tool for capital to achieve its ends, which has been well proven to do so, yet it's also nowhere, right? In influencing how that capital flows even before it gets down to the business level. So a way to think about this, in a way that I did think about this for the dissertation, is through reference concepts and boundary objects, which form the basis of comparison between design and investment, design and capital. So design and investment both have long histories of shaping human behavior and our conceptions of the future. Right? Design and investment both think about creating value. They're oriented towards the future. They creative analyze problems with limited information. There's a lot of common ground, if you take a step back, between design and investment. Right? And started to map some of these. And one of the big kind of overarching headers is design makes choices and investment makes decisions. And even just thinking about this puts everything into a new light. This is central to the research, so I'll repeat this, right? Design makes choices, investment makes decisions, and this is building on a lot of the work from Patrick Whitney. So this means that design is inherently generative and open-ended, and investment is inherently optimizing and close-ended. Both are very, very important, and they're very important to understand. So in the dissertation, I created a table which compares how design and investment approach issues from opposite angles. Design works forwards towards solutions, investment works backwards from problems. Information, the more information is better. In design, the more information, or scarce information, is actually a competitive advantage. Information wants to be fluid and highly changeable. In investment, it needs to be very fixed, right? Working from unknowns to knowns, or knowns to unknowns. Plurality, right? Even just multiple views of capital, which really built a lot on the work that Westland is doing. Is capital only financial, or is it natural and social and the like, or is it really just money? So all of these tensions start to color how we look at what's happening in the investment and design world, and when they have tried to interact, maybe starts to explain some of the challenges that they had. So with this in mind, started to think, how might design bridge the gap into institutional investment? So what levers and capabilities and approaches might already exist that, when applied, would work, and also what design approaches just flatly wouldn't work? So we started with a deep review of the literature, which reveals that there is a significant opportunity for design to contribute to institutional capital allocation. By specifically reframing the perceptions of the past and the future, design can create these new choice sets, really in the form of asset classes, which I'll talk about in detail in a little bit, that influence these future capital allocation decisions. So to summarize, design can create the choices that then these totally different investment decisions can flow from. So this research hypothesizes, or at this time it hypothesized that by integrating specific design capabilities into the process and flow of institutional investment can really help and develop a framework for design to influence capital allocation. So to do this, to take this from maybe an interesting theory based on literature to real empirical data, we structured a set of experiments, case studies, participatory action research, and interviews to explore this further, which I'll talk about now. So we go from where is design in all this, why is design transformative by nature yet not having anything to say about one of the most transformative forces, into, okay, well, how might design then influence institutional capital allocation? And I'll give some quick context just on process. This seemingly simple research question really only surfaced after 2 years in the PhD program. We initially thought that in a very narrow sense, speculative design could be really helpful in the infrastructure investment thesis generating stage, right? It was a very narrow and specific research question, which, I'm glad that we failed quickly and learned a lot about that, but we kept stepping back and abstracting out until we ended up at the truest source of capital flows, right at that CIO level where you're allocating $1 billion here or there. If we could find a way to design influence here at this level, then automatically design would be able to influence at all the levels under that, including to the production use levels where design has a lot of credibility today. So to figure out how design might influence institutional capital allocation, we put together a research model, right? It integrates reflective practice, participatory action research, systems thinking, expert interviews, graduate level design workshops. And it was designed to triangulate data from 3 sources and be analyzed through 2 specific lenses. And I'll talk a little bit about each. The first was looking at it from an investment perspective, using an institutional case study with an action research method. So this was that $100 billion pension plan where I led the infrastructure investment strategy team at the time. It was a 2-year-long intensive research context, which was a key part of the corporate partnership that offered one of the most really demanding environments that design could be, in which to test the capabilities and shortfalls of the current design capabilities. So I was using participatory action research, which means I was both the researcher and the participant and sort of many other things as we go. And luckily there's a large body of knowledge and theory to pull on to figure out how to make sense of it, how to deal with this ethically, how to split your roles and actually reflect on 3 levels, sort of me as a designer, us as a design team, and then sort of the field of design as a whole. So the data from this source included, tons of corporate artifacts, emails, memos, investment committee documents, investment analysis, corporate PowerPoint documents, all of which would be tagged and coded. The next, we looked at the same question from the exact opposite angle, from the design angle. So this was using the Institute of Design Sustainable Solutions workshop course. Carlos led and Dia and I were working in that. So this was a semester-long workshop where we wanted to understand design's limits in designing investable infrastructure. Even what would happen if we introduced this new concept of investable infrastructure to a design workshop, just to see what would happen and to start to map the boundaries from the other side. In this, we were looking at the future of electric vehicle charging and the future of controlled environment agriculture. So very kind of topical, future-oriented, massive infrastructure needs that design should have a role in, but also from an investable infrastructure component. And the way that we structured that course is to give them detailed prompts every week that slowly built up the concepts. Because, I mean, it would be unfair to expect that they're fully baked infrastructure investors, but to build, and I'll get into this in a little bit of detail, but to slowly guide the thinking and open up choices in some and narrow down decisions in others. The data from here included the weekly student reflections, all of their project work, the research journals, photos, presentations, final submissions, again, all tagged and coded according to the tags that I'll mention in a little bit. So this was all supplemented. We had the investment side, the design side coming together, then to get a mixed external component. This is with expert interviews. So this was a full set of on and off the record interviews with 9 men and 6 women across 5 countries, collectively with several trillions of dollars in assets under management, or being advisors or academics to these funds across all asset classes. So this was in Canada, the US, Middle East, London, Europe. It was a good cross-section of individuals. And the interesting part about these interviews was they were not super structured. They had a structure, but they were also generative. So I would show them models, we would explain, we would use that conversation as a starting point, and actually continue to push the model forward in those conversations, then go back to them to say, does this fill the gap that you had in our first question? So the data from here is interview recordings and transcripts, the interview guides, the prototype models, and again, tagged and coded analysis, which you'll hear a lot about. So all of these three data sources, these three very important empirical data sources, which I will mention, given the context of investment, were probably the only way that you could go about generating empirical data from the inside. These, as you can imagine, are very, very confidential, trade secret type of environments that you need a certain degree of sensitivity and confidentiality to deal with them in the right way. So being an embedded researcher versus being an external researcher gave access, but also just the nuance on how to interpret it, which was very, very important. But it would have just been sort of a meaningless data set had not been interpreted through the lens of reflective practice and systems thinking. And this was the participatory action research that I mentioned earlier. So I kept throughout this entire process, extensive journals of the experiments. These were daily, weekly recaps, notes to myself, just trying to make sense of it on the fly. I said, I'm not going to editorialize here. I'm just going to talk about what happened. To go back to, these are sketches literally on the back of napkins, on airplanes, notes from conversations to say, I think there might be something there. And just to give you some context for what was happening in the world, right? I talked about the human factor. The world was changing around us at the very time this research was happening, which was really fascinating. So, Ukraine invaded Russia during this. I'm Ukrainian, I have family in Ukraine, so that was kind of an interesting time to wear those two hats. There was a leadership change in actually several of the organizations that I was working with, which, happens all the time. Silicon Valley Bank failed when this was happening. I had my second son, trained for several ultramarathons, worked a full-time job with two-hat strategy and research, all while keeping the course load of the PhD. But I would say without this sort of journaling habit, things probably would have gone off the rails. So the reflective practice wasn't just, let's keep a journal on Dear Diary. It was a very, very important tool just to make sense of everything that's happening and to look back. And then the other one was systems thinking, right? Just to make sure that I'm looking at leverage points, I'm looking at micro, meso, macro, like where are these interventions starting to come out? So all of these things were really helping at the early stages informing where the tagging and coding should occur. So from this broad approach, from sort of how can design influence capital allocation, we ended up with three very, very specific questions with which to interrogate the data. The first was, what is the role of choice making in institutional capital allocation decisions? The second is, how might choices be created within these capital allocation processes? And the third is, what design capabilities apply to institutional capital allocation? So we're starting to hone in on what might be important, right? You see the role of choice making. You see the role of processes. You see the role of design capabilities, right? Like they're all starting to emerge as, there might be something here, and we should put a formal research program around them to understand what it is. So then we did the work, we did the research, using the approaches I just mentioned, the three pillars underpinning by reflecting and systemic approach, we went to work. And this is where all the foundational pieces from the first year of PhD, speaking to this side of the room, the work we did early on was important, right? All of the seminars, just mapping, remapping, triple mapping, doing literature review to make sure that you understand the author's argument better than they do was incredibly important because you started to stake new ground and different citations came up, which you would go like, I didn't even know that was going to be useful. I also did a workshop with Westland's business design class, even before the research started. This was one of those prototype, I think it was in this very room, fail early. It was a scenario planning exercise using multiple futures cards to get them in the headspace of, okay, you are, family office investor or sovereign wealth fund with X billion, your values are X, and you have these 5 things to invest in. I think we had some fun. We learned a lot. We definitely learned what design couldn't do and the limitations of both design and investment at the time, which was so helpful to then narrow the subsequent research. So from those information, so I mentioned tagging and coding quite a bit, and those information tensions I mentioned became big categories for tagging and coding, as well as the design capabilities and the systemic levels of the organization. So all of those research methods directly made their way into how the analysis was interpreted. So I'll go through each of these quickly. These are really the summarized findings of the data sets and analysis, and then I'll put it all together into the contribution. But I think this this is helpful because for you it just shows the rigor, how things were connected, and then after I'll connect the dots to how these pieces of analysis actually made their way into the final model. So on the first question, what is the role of choice making in institutional capital allocation decisions? And a really good example of this came from the research in the case study investment committees. So these are the very formal decision-making processes by which investment teams find deals to pursue. They, often in the hundreds of millions, if not billions of dollars. So these are very, very critical moments, probably the most critical moments of truth in an organization. So the teams will craft a thesis, and through several rounds of iteration with the investment committee, they eventually come to a decision. So data from these committees, which was then validated in generic terms with the experts and sort of other industry research happening at the time, showed how the initial internal categorization of these assets really significantly implicated the operational choices as well as the risk and return profiles that these teams could make. I mean, to simplify it, the initial seemingly throwaway decision to call something A or B put on a set of blinders and limitations for what you could do with that asset, which is really important as we see down the line. A good example of this is a data center, right? So oftentimes these data centers have a real estate component, they have an infrastructure component, they have a private equity component, all together. But traditionally in an institution, there would be 3 different teams who are responsible for those individual asset classes with no real way to integrate and sort of share it. This matters because the bucket you put that asset into will tell you on one side, whether you should pursue like an M&A growth strategy if you're in private equity, or put solar panels on the roof if you're in infrastructure. Like 2 vastly different ways you can run this box with a bunch of servers in it. And we see this situation over and over and over. The next was, how might these choices how might choices be created within capital allocation processes? So this kind of comes from the first question. It's like, well, if we understand how decisions are made, is there an opportunity to start to create a bigger set of initial choices? Maybe there is, maybe there isn't. And choice creation within capital allocation is very, very crucial because beginning with the broadest possible range of options, should theoretically enhance the decision-making process for investors. But there are several practical challenges that influence or that interfere with this process in institutional context. And this research revealed the presence of these sort of non-quantifiable yet significant constraints that warrant attention from design. It demonstrated that failing to consider a broad set of choices early on restricts decision-making possibilities to identify opportunities for even creating new asset classes. So now we're not saying which pre-existing bucket does this fit into, but hey, should we actually create an entirely new bucket with an entirely different set of risk, return, and business model expectations? So we work closely, a simple example, we work closely with the venture capital team, exploring these opportunities at the intersections of these major steep themes. So this would be stuff like carbon capture and storage, where it's too much technology risk for an infrastructure investor, but it's too much capital expenditure for a venture capitalist. Yet both can agree, and I think we all in this room, like this is one of the things that sorely needs both capital and the smarts of technology to solve. But the way institutions are set up just really can't make sense of this right now. So we used a design-led strategic foresight method to really push the concept of anticipatory capital allocation with these new creation of asset classes, which was a pretty novel concept for these institutional investors. And it highlighted the role of several design capabilities that were and weren't useful in doing such an exercise. And then lastly, the question of what design capabilities apply to institutional capital. We're starting to get down to, okay, there's decisions, choices, there's a process. Okay, I think there's an opening, but now what do we do as designers? We can't just go and say, hey, I'm a designer. There's specific capabilities, tools, and starting to narrow that down. So to understand how design might play a role in influencing capital decisions, we started to understand really what design currently knew about investment and where we could push the boundaries of institutional constraints. So this, I think, represents the first example of investable infrastructure research conducted and documented in a design context. We really couldn't find any precedent. We were looking to say, surely someone's done this before. We can get some tips. Examples were few and far between and very, very tangential to direct application of design into anything that's investable at that institutional level. So the experiment took place in the Sustainable Solutions Workshop, which provided 2 instructive examples: the use of prompts and the context archetype matrix, both of which are are referenced down here, just to show you an example of the types of artifacts that were coming out. And I'll quickly explain them. So first, the design prompts. So this is an example of something that was given to the students before every weekly class, which Dia and I put a lot of thought in together. And it has a couple very specific components here. And I'll talk about the first. It's like, how do we abstract infrastructure into the most basic level? So we can explain to a bunch of design students that rightly wouldn't have any knowledge of investable infrastructure. What is infrastructure there to do in the first place? Okay, well, it's always changing, but two things seem to always remain true. Humans have always needed to generate, move, and store things, right? And infrastructure emerges from the interaction of human and non-human. So already, you've got an interesting way to sort of recategorize. Like if you think about asset classes, you can almost think of typologies. So there's infrastructure that generates stuff, there's infrastructure that moves stuff, and there's infrastructure that stores stuff. So it's a way to narrow it down to say, I'm in the movement business. There's still a ton of really interesting stuff you can do, but you're not doing everything. And then we layered on, additional prompts like these 3 Ds, which we've talked about: decentralization, digitization, and decarbonization. So these are 3 underlying trends that are really changing the nature of physical infrastructure around us. As decentralization, I'll give you an example with solar panels. So rather than having, a fixed power plant that distributes out, the actual generation itself is just distributed. New type of infrastructure, which requires a new type of managing that asset. Digitization is not only digital infrastructure, but it's also the digitization of existing processes within kind of large monopoly organizations. And then decarbonization, I think is self-explanatory, but getting to the extreme ends of the chain, where how do you decarbonize very, very carbon-intensive industries, like steel making, for example. So by carefully crafting these prompts, the research inherently limited the range of possible decisions available to the students, and the constraint was deemed necessary from a practical perspective, given the novelty and perspective. But it also showed then how these choices could influence decisions. It was interesting here because the choices in categorizing and framing the project illustrated how when you reframe it, you get radically different outcomes, stuff that we didn't expect or we couldn't have predicted. And then you also get a different set of decisions on the other side. So I'll give you an example. So instead of questioning, like an institutional investor might, is this EV charging technology a good investment? I mean, I guarantee you there's 10 pitches going on today in boardrooms around America that they're asking the same question and they're pitching a business. I guarantee you nobody's asking, as investors, what should be electrified, right? It's a totally different question, same tools, same capital, same need for electrification, but you're coming at it from a completely different way, which going through the design process, we learned that we could come up with these different questions, right? And it then illustrated how design capabilities such as abstraction, reframing, abduction, synthesis can effectively simplify complex and seemingly incomparable concepts. And then the next concept over here was the concept archetype matrix. And this was developed to integrate insights from both the investment and the design space. The classic 2x2, demonstrates 4 strategies for reinterpreting investment choices by anchoring them to existing reference models. Again, just trying to break out of what we think into things that are similar, and maybe if we look at it in a different way, we can get different outcomes. So these models change depending on market conditions, context, or the type of investment archetype. The matrix highlights the shared commonalities across these asset classes. And the research found that in the realm of investable infrastructure, context and archetype are foundational components for designers to work with. Again, relatively undiscussed in the investment world, but very, very common for design to talk about, and when applied to investable infrastructure, yielded pretty novel results. So this again represents the initial confirmation of the benefits of design capabilities, very specific design capabilities in a very specific context for a very specific purpose, abstracting, reframing, synthesizing data, and also communicating it back in a really clear and compelling way. So as a result of all this research, these are sort of the 3 big insights to summarize, 1.5, 2 years of work. The first is that there's the growing discrepancy exists, and this refers to the capital paradox, between the decisions that funds can make and the choices presented by the external market. Funds are equipped to do one thing. The world is changing in such a way that it's increasingly different from what they're equipped to do. Right? We validated this 3 or 4 different ways. The second is that asset class choices strongly influence the subsequent decisions available to asset managers. Again, may seem obvious, but the important piece coming at it from a design and research perspective is that asset classes then become a unit of analysis. It becomes a discrete thing that you can approach and do something with, which becomes very, very important. And then lastly, design capabilities, abstraction, reframing, abduction, synthesis, foresight, mediation, and connection emerge as this very powerful set of tools to help investors explore new asset classes. So then when you start to put that all together, what do you get? You get what is the main contribution of this dissertation to society, right? It's 8 design capabilities for capital allocation. It's seemingly simple, and I'll break it down on my left-hand side and the right-hand side. So first is these design capabilities, right? And this is no surprise to anyone. Researchers have thoroughly deconstructed and documented these design capabilities in many, many, many contexts, which on one sense is good because they're proven entities, right? But the previous explorations, as we started to look at them and started to dig deeper and look for examples, we found them in almost every conceivable context, including architecture, healthcare, management, fashion, product, service, community development, you name it. But conspicuously absent was any example of any of these specifically as a design capability in institutional investment contexts. So the unique contribution of this research here lies in the careful selection, contextualization, and application of the capabilities in the context of institutional investment. And they're presented here roughly in a way that you might approach it. It's not a linear process. No 2 challenges are the same. You might just need 1, you might need 2. But if you were looking holistically, if an investor came and said, hey, I agree with your premise. We experience the capital paradox. I can't match the way my capabilities are set up to the way the world is evolving. Help me. This is a kind of a rough way that you might approach it in sequence. So you start by abstracting the portfolio into a set of underlying drivers. You can project those drivers forward using strategic foresight. You can start to make sense of these drivers in the context of new and alternative future scenarios. You reframe the drivers as new asset class choices across the given scenarios. You can then synthesize the results in conjunction with the goals and capabilities, the concrete objectives you have as a fund. Use abductive reasoning on the implications to investment strategy and decisions, all while underlying mediating and connecting across the different system levels and roles within an organization. So very quickly, again, just to define, and these are very, very simple 5-word definitions, but just so we're on the same page, abstraction means distilling an entity down to its core. Foresight is creating alternative futures. Sense-making means distilling complexity into actionable concepts. Reframing is shifting perspectives to find new links. Synthesis is filtering data into cohesive structure. Abduction or abductive logic is forming new logical and explanatory hypotheses. Mediating is bridging creative and scientific mindsets. And lastly, connecting is integrating and brokering knowledge. Now, we didn't start with these set of 8 capabilities. We added some, we took some away, and this was the process of the research. As I mentioned, we first thought that speculative design would be a really powerful tool. It was almost, to be honest, too powerful a tool for some of these investment contexts, which is good. I mean, keep in mind these investment contexts are designed to be repeatable and rigorous, and they have a very, very important purpose, and they do a good job at that. So anything that just totally undermines the foundation, probably a bridge too far. We also thought that we might need to add things, and this is an example of abductive logic, of just, it's kind of between inference and deduction, on having a better explanation of what's happening, given that you're not going to have data. And even this not going to have data terrifies investors because they're always used to making very reasoned decisions on all the available data. There are certain things you just can't know, and getting comfortable with that means there's a really important role for abductive thinking. But it wasn't enough just to have this list of capabilities. It would leave us awash in where do I apply them, when, what's the context. There's no grounding in the very institutional context from which this problem was born. So they needed to be situated in this framework, which this is the capital design framework here. And I'll very quickly start from the middle and work out just to explain the individual parts. So the inner ring, really this starts, you can think of this as the equivalent of the desirability, feasibility, viability of the design world. So in the investment world, are there the right business foundations? Is the right fit for the portfolio at the right price and maybe the right market conditions? These are just anchored in the daily realities of the investors, essential investment questions. questions. And these were informed primarily by the case study, specifically the participation in the investment committees, supplemented by the expert interviews, and tested in the student workshop. The next, we go out to the information tensions. This is the blue ring. So these investment questions, very natural questions these investors have, are filtered through their tensions. They go out into the world and try and make sense, okay, how do I solve this problem? And depending on if you're a designer or an investor, or if you're trying to make a choice or make a decision, these different lenses cloud the way you interpret data. And they often show the disconnect between choice and decision. So this was primarily informed by the literature review and student workshop and supplemented through expert interviews, case study, and reflective practice. We have the capital allocation tools on the outer ring on the right side. And again, to situate this as much in the reality of institutional investors, this is like somewhat the equivalent of the design tools that we might have. These are the way that they translate unstructured data and information into these investment theses. So you've got long-term strategy, portfolio models, macro sensitivities, thematic research, and the like. And this was really informed by the direct observation and participation in the creation of a lot of these tools. And then on the other side, you have the corresponding design capabilities. They complement the questions and the tensions and the tools. And better yet, they actually pair quite well depending on the circumstances. And then lastly, you have this choice and knowledge axis. And this is taking a step way back to say, okay, what's the meta knowledge, what's the meta understanding that actually turns this collection of mildly interesting observations into a very cohesive when-then framework. And this whole concept with the 2x2, are you trying to make choices? Are you trying to make decisions? Are you dealing with things that are fundamentally unknown and unknowable? Or are you dealing with things that can be knowable? This is where the capital paradox came from. So even then, that capital paradox, which really grounded a lot of how the research was put together, came halfway through and then changed the way it applied a new layer of clarity and meaning to all of it. So you can think of this in an example for a capital designer can understand the framework as a when-then logic statement. So for example, let's say you're creating new investment choices. So you're on the choice side, you're dealing with some unknown dimensions, so you're at the top left there. So then you can start to look to abstraction, foresight, sense-making, and abduction, which can be applied through the tools of the long-term strategy, the portfolio view, the macroeconomic drivers, and thematic research. Right? So once the context defined, the capital allocation process can be simplified to these practical scenarios. So this is where a lot of the testing and the participatory action research was, what does long-term strategy look through a foresight lens? Like, how do you actually bake in multiple futures into something that's usually a linear future? Very, very interesting. It's not always obvious and it's not always successful. Or how do you use mediating in the capital rotation process where you're trying to bring people together? They have different goalposts, they have different understandings about what needs to be accomplished. You can show how design capabilities can show up in different ways to actually help that initial starting set be successful. So we made the contribution and then we take a step back and we look at, well, what's next? What now? Like, does the world change at all? And some implications that we talked about, there's really three, right? So once you have capital design as a framework that you're reasonably confident can influence institutional capital allocation, well, you start to deal with the evolution of the institution itself, right? And then you have the evolution of capital allocation itself. And then you have the evolution of design education to build this community of capital designers. So we started by saying that capital is one of the most transformational forces of the 21st century. And now at this point in the research, we can get a little bit more specific and say, really institutional capital within that is one of the most powerful forces. And so therefore the implications start with the institution. So the role of the institution then becomes very, very, very important given the massive challenges that we're talking about, because no nation, organization, or institution is really equipped to independently address these societal megatrends. Financialization and universal ownership, for all of the systemic risks that they cause, actually enable this massive opportunity for collective action to form these kind of supranational multi-fund alliances, which we're already seeing happen. We're seeing these universal investors wake up to say, hey, we're both invested in all these three things, which are all reliant on GDP, which is probably reliant in trust on public institutions. What are we as a bunch of institutions doing about that? Because no government can start to solve that. So they're slowly starting to wake up. to this kind of supranational multi-fund alliance. Capital design offers them the possibility of really anticipating these consequences and leading the conversation on it. They can envision alternative futures and new investment options as new asset classes because ultimately they still need to pay the pension, but they have a history of doing this, right? Like carbon credits, investable asset, even infrastructure itself never was a formal asset class until 20, 30 years ago. The need for institutions to continually deploy capital and meet returns far surpassing what a municipal bond could get you, turned it into a massive opportunity. So then, if we think about capital allocation, the argument presented in the study emphasizes that we need to think differently about capital allocation itself. What is it there to do? Right? By integrating the rigor of investing with the logic of design, the capital design framework emerges, which brings new implications for institutions, capital allocation, and the role of education. Right? So capital design offers benefits to any institution. So now we're not looking just at what can institutions do, but anyone who's allocating capital. Right? So these are equally important to NGOs, investment banks, strategic investors, systemic investors, family offices, GPs, regulators. It's not just for institutions. Though the research was born in the context of solving an institutional challenge, there's no reason why anyone who's thinking about capital allocation can't say, well, I'm also making decisions with limited data. I seem to need to make choices over here. Is there anything I can take from capital design? And then lastly, one of the most personally fascinating things from this was conversations with these investment experts, industry veterans, design academics, constantly asked, after the interviews they followed up with me is, so where do we find more capital designers? Where do these people come from? Or with the students at ID, and I also gave a presentation at Rotman in Toronto about this, is so how do we become capital designers, right? Both same questions, kind of supply and demand. And this recurring question highlights a significant implication, right? So by merely providing investors or designers with the framework, I think is insufficient. The research implies that it's kind of equally uncommon to find individuals who are as adept at navigating the concrete macroeconomics as they are abductive reasoning. So the question then becomes, how do we scale capital design, right? Whose responsibility is it? What is the role of education? And I've reached the limits of what this dissertation, but that's one of the implications, which if we believe in the power of capital design, where will the next wave of capital designers come from? So, we know that the paradox exists because institutional investors are optimized for decision-making within a very rigid framework of these preset asset classes. It makes total sense why they have the asset classes. They need to match what the market's doing. They need to match what the peer's doing. It's not a knock on them. It's just a reality check on the way that you're set up is less reflective of the way that the world works. But capital design offers a pathway to transform the paradox into what we can start to call perhaps the capital paradigm. So I'll repeat. Capital design can transform the capital paradox into the capital paradigm. So while rather than being hindered by increasing complexity and variety of choices, institutions can thrive from them. So for example, when institutions benefit from the abundance of choices and they actively welcome it and they're actively feeding new choices back into the marketplace, they're better positioned to continually develop, assess, and refine the investment opportunities they consider by really skillfully applying these design capabilities. So such a dynamic approach empowers them to make decisions with greater assurance, better understanding of the risk, better conversations with their boards, and ultimately fulfilling their duty as a fiduciary. So what we can see, kind of this bit of an eye chart of a graph, but the past, present, and future of capital allocation. In first, it really made sense. If it's infrastructure, a toll road, that's going to fit neatly in. Real estate, office, retail, private equity, and business. Fixed asset classes, fixed opportunities, that's how the world was for the last 20 years. Present, we still have those same asset classes, but the investable opportunities are changing. We're seeing data centers, renewables, fiber optics, logistics, life sciences, all of which could be any of these private market asset classes. So the asset classes are fixed, but the opportunities are permeable. And then perhaps a future with capital design, both the asset class and the investable opportunities become emergent. Whether you look at the 3Ds, what are the opportunities, for example, to decarbonize, decentralize, and digitize? Maybe those are the way that investors look at the world. And then it makes it way easier to then digest what the world's presenting them using these design capabilities. So I think this is what we can achieve when we blend the rigor of investing with the logic of design. Right? Capital design is how we put the power of transformational institutional capital to work on society's biggest challenges. while still meeting their fiduciary duties that these institutions so nobly fill. So design capabilities have never been considered in the context of investment, nor have capital allocation challenges been analyzed through the design lens. And this is where I want to get to sort of the implication beyond the implication, and really talking to design here for a second. We have this opportunity where design can influence not just capital allocation, design can influence through capital allocation. We've explored the application of design capabilities within the realm of institutional capital allocation. We've introduced these 8 capabilities that, when properly structured in that framework, can bring choice-making practices into how institutional investors make decisions on long-term capital allocation. And consequently, design can become an influential practice by envisioning how these investments can shape the future. Right? So this research offers a baseline for how design can understand the context of investment. Right? This fills in the gap that we introduced in chapter 2. We now have the context of investment with capital up the middle, constraints, factors, and goals. There's, if anyone's interested, this is all in the appendix of the dissertation, but we've put design in this new context that successfully builds on the skills it have and puts it in kind of one of the tailwinds of one of the most transformational opportunities that we have ahead of us. So I'll just pull a quote out to really frame this for everyone. Right? Design holds the power to shape institutional capital allocation. This means that design can also significantly influence the world around us through capital allocation, far beyond the scope of anything that institutional investors can do. So in the coming decade, trillions of dollars will be directed toward transforming economies, environments, and societies. So hopefully design will play a leading role in influencing significant positive change in institutional investment. So what's next? Before I open it up for questions, I'll pose one to all of you. So Carlos tells me that after 3 years, one earns the right for kind of one single provocation that's totally free from citation, which is primed for conversation, and it's this, right? So in this context, I want to share this provocation, invitation for you. So if capital needs design to remain credible, and design needs capital to remain relevant, does society need capital design to remain viable? I guess what I'm asking is, what new possibilities does capital design help us unlock? What questions can we now ask? Right, if institutional capital is this massively transformational force, and we have the tools to influence, will we? So are we ready to shift from the capital paradox to the capital paradigm? I obviously have my own thoughts. You've just heard them here today, but I can't continue this alone. So who's with me? With that, thank you.
So we can have about 5-10 minutes for question and answers. Which is for anyone to interact with Jordan.
Yes.
Thank you for that. That was amazing and an excellent example to all the students in here of how to succinctly do that. And I really appreciated how you didn't just keep addressing design writ large. You broke it down into those specific qualities and repeatedly said this is a very specific context. I'm curious, as you first started the research and you were doing the embedded interviews and the work, before you got to that and you were sort of coming in like design, what challenges you faced with your coworkers, colleagues, people you're working with to explain what you were doing, and then related to the participatory action research where you have your own positionality and your intentions are so much a part of that, like how did you balance, like how much do I push into this and sort of push my agenda of working with design or work with people where they are and not try to force the research environment?
So I answer that 2 ways. One, I relied on 2 very important pieces of theory which just helped ground where to start. The first was John Heskett played a number of roles, but specifically I was starting with, well, why hasn't design been able to articulate its value? And that's what I was experiencing, because I was, for the last decade of my career, I've been this kind of token designer in a room full of capitalists and token capitalists in a room full of designers. So I knew that intuitively. So starting in what he was saying was it needs to understand the process, technology, and context of the economic system that it's in. So that's helpful because then I can start to pinpoint. Another one is actually Patrick Whitney's Economy of Choice article that provided the initial starting set of design capabilities presented in a somewhat similar way to here, albeit solving a completely different problem. So I had a starting set of what might be useful. And then the real trick, I guess, was translation. So understanding the context, understanding the language, and would I come in and say any of these? Probably not. I'm not going to say, hey team, we're going to do an abduction exercise. They probably think I'm kidnapping somebody, right? Versus, what if we thought about it this way? Or just raising questions to say, okay, we're talking about EV charging. Does anyone have an idea about millennial attitudes towards car ownership? Right? And people, I don't know, let's ask McKinsey, or let's Google it, or let's talk to my teenage daughter. You start to slowly expose, maybe we don't know, maybe because it's not easily quantifiable, but it's obvious to everyone that this is a material piece of information. So it was kind of like slowly testing, slowly introducing. You have a conversation, you say does this seem interesting enough that you'd let me take this away and do a bit of analysis? So building in, a bit of foresight into the future of digital infrastructure, right? So it's not just about, Norway having geothermal and that's good for data centers, but it's like the whole idea about latency is the closer you are, the faster the latency. But if people are looking at old Facebook photos, you actually don't need high speed, right? It's a really, how people are going to interact with data into the future is a material driver of this business case, which nobody was talking about. So it was starting with those, early as the door opened, maybe we can translate, and then going in and afterwards just hey, congratulations, you did your first foresight exercise, you didn't know it. I'm happy to then deconstruct what we just did, right? We looked at the things we're uncertain about. We crossed them into scenarios. We looked at some strategies. So it was a very much a gentle leading process, because I also had to do the job. So it would often be we'll do the analysis your way, and we'll also get the opportunity to do it our way and see if we can blend them in. And there were times where it was really helpful and times where it wasn't. And I think both of those were okay. Yes?
So if someone was to use this, how would they do it? So should we start from the center ones, the one that you've taken inspiration from the balanced breakthrough framework, which is the right foundation, right price. From there onwards, you make the decision to use this framework?
The other way around. So as a designer, start from the outside, take a temperature of the situation, say, what does it sound like we're trying to do here? Is this a decision making? Because oftentimes you have to make decisions, and this is where it's not always going to be design led. There are times where you have to make a yes or no decision, right? And I think that's where early on I didn't fully appreciate the humility that design had, because things need to get done, dollars need to go out the door, and this is where you can be more investment led, design supported. Or on the other side, to say we're at the early stage, we're doing some early thematic research, we probably benefit from a bigger set of starting choices. Let's let design lead, but maybe we're dealing with stuff we know. Or stuff we can know, we just don't know. Or even having the conversation about, are these things knowable, right? And that's, we had really interesting conversations with folks from the risk profession about, risk is anything that you can attach a probability to, and anything that's uncertainty is things you can't know, but you have to deal with anyways. So you start kind of from the outside in, you get into the right quadrant, and then kind of that blue layer might help you explain if there's some disconnects, because we're looking at the same piece of data, but you think that we shouldn't share with anyone, and we actually think we need to get it validated by 10 different people. That's a source of confusion. And then you can get to a better decision. What does it actually mean to be the right fit? You're going to come at it with a totally different set of data, and then you can actually answer that question kind of with a broader perspective. Yes?
Could you go to the next slide, the capital paradox to the capital paradigm? I just wondered, maybe this is a big question, but at a moment when capitalism maybe isn't so popular, how you think your research enters into that world and its value?
That's a great question, and that's kind of what I was getting at here, right? Does capital need design to remain credible? Is there a credibility crisis with capital? I don't know. I didn't want to. The dissertation was not the opportunity to make value judgments, but there very much is a discussion out there. And my point of view is, if you can have more information, it is the rational and more likely thing to do to make a better decision. Institutions were dealing with not a full stack of information. So I still think that capital can be massively transformative. Design doesn't have a role at all. So rather than standing outside and throwing rocks to this glass house, I think it's better to be inside, understanding how it works, and having a hope of influencing it into the future.
And a couple of really ignorant questions from the finance perspective. So the first one, what's the difference between a choice and a decision? Since that seems to be the two halves of your circle, what's the difference between a choice and a decision?
Choice is effectively creating new options, decision is narrowing down into a single.
Right. So in your example of every boardroom is thinking about, should we invest in this EV company? And what they're not thinking about, or maybe they should be thinking about, or they ought to be thinking about, is a more proactive perspective, which is instead of being reactive and saying we have an investment opportunity available to us, should we make a decision to invest, we can be proactive and think of what are the kinds of companies we should be thinking about investing in, and then go out and find those kinds of. So if I think that EVs are going to be attractive to young car buyers, I should go out and proactively look for opportunities for companies that are in that space. Instead of being, it should be proactive about what you want to invest in versus reactive about what you can invest in. Is that?
At the institutional level, I think you have a bigger opportunity because of the sheer scale of capital. Rather than just waiting for the markets to present you with a decision, you can actually go and create a market, right? If you understand, if as a board you say, what is EV charging actually trying to solve? There's going to be a range of things, like new choices for you, and say, are there things that we can invest in really early stage that will make a market in this other thing that we think EV charging is actually solving? So it's, yes, you can start to look at what's out there, but it's kind of the difference between, you know, normative and anticipatory scenarios, where you often see this with big institutional investors using like gas pipelines, where liquid natural gas, they don't know what the world is going to be, whether it's going to be hydrogen, electricity. So they kind of hedge their bets, and they'll just, well, we'll invest in a pipeline for the next 20 years. But by doing so, they've actually locked in that technology for the next 20 years. So rather than saying, no, we actually think that it's going to be X and we're going to go do something about it, perversely by hedging their bets, like by not realizing they've already made a decision by doing something, I think that's what it is. Because these boards are saying, you're telling us about EV charging, we have to put it in one of these three buckets, no matter how naturally it fits or doesn't fit. What the choice making would be is, do we need an asset class around circular economy? Do we need an asset class around energy transition? And there are a few pioneering plants who are starting to think this way, and that's what I mean, is like they're actually creating a whole new set of choices just by saying circular economy as an asset class, totally different set of starting choices. In fact, probably many that we don't even understand yet because no one's looked at it that way. Yes, Mark.
So I'm curious to know, to what extent the funds that you canvassed and talked to, how many were going through some of these 8 strategies, either deliberately or intuitively? And to what extent were you able to find a correlation between their use of these strategies and maybe some measure of success that they might have?
They were, to some degree, kind of stumbling upon this type, like design type of thinking. They weren't calling it abstraction or foresight, but the people I interviewed often recommend, like, oh, if you're talking about this, you need to talk to this person because they're ahead of the curve, and you talk to them and like, yeah, just the tools I have are limited. I'm thinking about this from a common sense perspective. I'm not even calling it anything. I'm just coming at it as a person off the street to say, we have fiber in the ground, we have pipes in the ground. Do those two things display the same risk profile? On paper they do, but in reality, do they? So to answer your question specifically, did I then go and draw to the results? No, and I'm not sure that you could do it in a timely way, given that these are long dated 5, 10, 15, 20 year. But these were some of the most successful, multi-$100 trillion, and these are very, very successful investors that the way that they explained it to me largely got to be like that by asking these questions, or at least embracing that type of thinking on their teams. It was mostly an open conversation about, hey, I'd love to do this, but organizationally we just aren't equipped to do it. Like, can you help? Like, it was more of, I agree, I'm not sure how, I'm not sure what to call it, I'm not sure who's going to do it, I'm not sure how to fit it within the existing confines, but yes, like we absolutely need to have a different tool set to toolkit to take in non-quantifiable information into these very important decisions. Yes.
Last question, yes.
Okay, I have one question. Great presentation, really exciting work. And I have a few questions, but I think my last question would be, to what extent innovation and technology policies are kind of helping or kind of pushing for that change towards a new capital paradigm? Are there any influences, or are there any kind of I don't know, do they inform this transition anyway, or are they helpful or detrimental in your work?
In the context of innovation and technology.
Policies that, for example, shift towards green technology.
Oh, from a society perspective.
Yeah,
Oh.
bigger society.
Yes, but the capital design or the design capabilities that underpin capital design is intended to take those into account, right? Just to make sense of it. So when I was talking about the context archetype, the big context change was the IRA, the Inflation Reduction Act, which has nothing to do with inflation, but it's the massive subsidies for electric vehicles. Like that totally changed the context for investment. Things that didn't make sense last night make sense this morning. So I think innovation and technology policies would be another way that design can just help make sense, layer in, and add to all the other context changes that are going on.
Thank you, Jordan. So we conclude here the public presentation, the public defense, and we now, if you guys want to continue the discussion, we're going to take Jordan, give him a break, and we're going to go to another room and have our internal meeting, and then we come out of that. Okay?
Thank you, everybody.
Thank you.
Good luck.
Thank you.